Goldman Sachs just told the world that gold is heading to $5,445 an ounce. And the S&P 500 is going to 7,600 by April 2027. And if you're not at least a little curious about what that means for your money, we need to talk. We're sitting at a moment where two of the biggest assets on the planet are being handed a very public price target. And the question isn't whether Goldman is right, it's whether you're positioned before the move happens. Let's start with the S&P 500. Currently sitting around 7,126, and Goldman is calling for roughly 7% upside over the next year or so, which, honestly, sounds modest until you remember that 7% on a large position is real money. The vehicle most people use to capture that ride is VOO, the Vanguard S&P 500 ETF, which is about as close to just own America as you can get without buying every stock yourself. Now, gold is the spicier conversation because Goldman is projecting a climb from $4,830 an ounce all the way to $5,445. That's roughly 13% upside. And the instrument most retail investors use to get there is GLD, the SPDR Gold Shares ETF, which holds actual physical bullion so you're not storing bars under your mattress like some kind of anxious medieval merchant. GLD gives you the liquidity of a stock with the exposure of a vault, which is a genuinely elegant solution to a very old problem. Here's where the story gets strange though. Because gold is supposed to be your safe haven, the thing you run to when the world is on fire, and this year the world was absolutely on fire, geopolitically speaking. While gold dropped about 19% after previously doubling from January 2025 to March 2026. That's not a hedge behaving like a hedge. That's a crowded trade getting unwound, and the irony is thick enough to spread on toast. Think of it this way. Imagine you bought an umbrella because everyone said it was going to rain, and then it rained, and your umbrella just folded inside out and got ripped from your hands. That's essentially what happened to gold investors who bought late in the rally expecting the geopolitical stress narrative to keep lifting prices instead. Profit-taking by early holders crushed the asset precisely when people needed the comfort most. The reason this happened is actually pretty textbook once you understand market cycles. When an asset doubles in price over roughly 15 months, it accumulates an enormous base of investors sitting on fat gains, and all it takes is a little turbulence to trigger the exit that becomes a stampede. Gold's low correlation with stocks is a feature of its behavior over long periods, not a guarantee that it won't sell off when investors need cash or when momentum reverses sharply. Historically, gold has done exactly this kind of thing before spike. Correct violently, then resume a longer-term uptrend. And the people who got wrecked were almost always the ones who bought the narrative at peak hype rather than buying the asset at a reasonable entry point with a disciplined position size. We've seen this playbook in 1979 to 80, in 2011, and frankly, every major gold cycle has had a moment where true believers had to either hold through pain or become cautionary tales. The misconception that trips most people up is thinking that Goldman says it's going to 5,445, means it's going straight there in a comfortable, linear fashion. It almost certainly won't, because markets don't care about your feelings or Goldman's spreadsheet on any given Tuesday. What Goldman is giving you is a directional thesis with a time frame, not a permission slip to ignore volatility or size irresponsibly. The practical lesson here is that both of these calls, the S&P 500 to 7,600 and gold to 5,445, are most useful as a framework for thinking about allocation, rather than a signal to go all in on anything right now. If you've been meaning to dollar cost average into VOO or initiate a GLD position as part of a diversified portfolio, a Goldman price target with a clear rationale is about as good a fundamental backdrop as you're going to get. The real edge isn't in being the most convicted person in the room. Conviction is actually a little dangerous when it makes you blind to the counter thesis. The edge is in having a process that lets you participate in an upside scenario while surviving a scenario where Goldman turns out to be wrong by a year or two. Position size is the variable that separates the people who compound wealth from the people who have great stories about the trade that almost worked. Here's the philosophical truth underneath all of this. The S&P 500 going to 7,600 is a bet that American corporate earnings power remains durable, and gold going to 5,445 is a bet that global uncertainty, currency debasement, and central bank demand continue to support the metal, and both of those things can be simultaneously true without contradicting each other. Owning a little of both through VOO and GLD isn't hedging against yourself. It's acknowledging that the future is plural, and your portfolio should probably reflect that. The people who thrive through these cycles are almost never the loudest voices calling the exact top or bottom. They're the quiet ones who sized appropriately, rebalanced mechanically, and didn't let any single outcome define their financial life. Discipline, sizing, and consistency are genuinely the boring superpower that the financial content industrial complex will never make a viral video about. Whether Goldman's targets hit on schedule, overshoot, or take an extra 18 months to materialize, none of that changes the underlying logic of owning quality exposure to equities and a modest allocation to gold. As a portfolio stabilizer, you can be comfortable with any outcome when your preparation is rational rather than emotional. The market will do what it does, and your job is to still be solvent and positioned when the move finally arrives. If you're just starting to think about how to build a portfolio that can participate in moves like these, the best time to get educated on your options was yesterday, and the second best time is right now, because the gap between knowing and doing is where most people lose the decade. And if you want help getting started, whether that's real estate investing, home contracting work, or finding the right lenders, check out our links in the description below.